Your money is being used in a way most people never see, and it's happening quietly every single day. Subscribe now, because once you see this machine, you can't unsee it. What if I told you that the United States doesn't just borrow money? It quietly buys its own debt back using a hidden financial loop that most textbooks never explain. What if the world's largest debtor is also secretly one of its largest buyers? And that this trick shapes your savings, your inflation, your wages, and even your future? The story doesn't start with a scandal. It starts with paper. Clean, boring, official paper. Treasury bonds, bills, notes, the quiet backbone of the modern financial world. They are sold as the safest investment on earth. Governments buy them. Pensions depend on them. Banks hold them like sacred ballast. Your retirement likely touches them without you ever knowing it. They are supposed to be the most honest promise in capitalism. Lend the government money today, and the government will pay you back later with interest. But here's where the room gets darker. Because the United States doesn't just sell these bonds to the world, it also, quietly, buys them back. Not with tax revenue, not with surplus, but with money that didn't exist moments before. And that single act, repeated day after day, year after year, is one of the greatest financial illusions ever engineered. To understand how we got here, you have to rewind to the moment when debt stopped being a burden and became a tool. After World War II, America sat on top of the world's industrial food chain. Its factories were intact. Its currency was trusted. Its gold vaults were full. The dollar became the world's reserve currency not by accident, but by design. Other nations pegged their money to it. Trade flowed through it. Oil was priced in it. Debt was issued in it. The world began to breathe in dollars and exhale goods. For decades, the U.S. could borrow without fear. Investors didn't question the safety. Central banks didn't demand risk premiums. The bond market grew quietly like a shadow financial nervous system beneath the global economy. Every crisis only made it bigger. Every war stretched it further. Every recession deepened the habit. And then something subtle changed. In 1971, when the dollar broke its final link to gold, something metaphysical happened. Money stopped being a promise to deliver metal. It became a promise backed only by confidence. And confidence is the most fragile collateral on earth. From that moment on, debt no longer had a physical ceiling. The only limit was political tolerance. The government could now spend first and justify later. Bonds became the bridge between urgency and reality. When Washington needed money, it issued treasuries. The world bought them. Foreign governments, pension funds, banks, insurance companies, everyone lined up. The U.S. government took the cash, spent it into the economy, and promised to pay it back later. But the interest on that growing mountain of debt began to compound. Quietly, relentlessly, like gravity. Every year, more bonds were issued just to pay interest on the previous bonds. Debt was no longer funding progress. It was feeding itself. And then, in the early 2000s, the game evolved. The Federal Reserve was never supposed to be a direct buyer of government debt in the open market for permanent financing. It was designed to guide interest rates, not to fund the government. But after repeated financial shocks, dot-com crash, 2008, pandemic collapse, the Fed crossed a line that once would have been unthinkable. It began to buy massive amounts of U.S. treasuries with newly created, not taxpayer dollars, not savings, but electronic money created with a keystroke. A quiet rotation started. The Treasury issued bonds. The market absorbed them. And then the Federal Reserve stepped in and bought those same bonds from the market, injecting brand new dollars into the system. On paper, it looked like stabilization. In reality, it was the government quietly becoming its own buyer. This is the bond trick. The left hand borrows, the right hand prints, and the public sees only the illusion of external demand. At first, it seemed harmless, even brilliant. During crises, this mechanism prevented markets from seizing up. Liquidity flowed. Panic cooled. Asset prices recovered. Politicians celebrated stability. But the side effects were not visible on stock tickers. They showed up in living rooms, in grocery aisles, in rent notices, in quiet conversations about why everything suddenly felt more expensive. When the Fed creates dollars to buy government bonds, it expands the money supply. That new money first flows into the financial system, through banks, dealers, institutions. Asset prices react first. Stocks rise. Bonds stabilize. Real estate inflates. Those closest to the source get rich quietly. Those farther from the source feel the effects later in the form of price increases. This is not a conspiracy. It's physics. Money moves like heat. It flows from high pressure to low pressure. And when trillions of new dollars enter the system through the bond market, the pressure cannot stay contained. The US government gets to spend without immediate political pain. Voters don't see new taxes. Congress doesn't approve austerity. The Treasury gets funded anyway. And the illusion holds for a while. Foreign governments notice the game. Some keep buying. Some hedge quietly. Some shift into gold. Some move into bilateral currency agreements. The world begins to diversify away from pure dollar dependence not because of ideology, but because of arithmetic. Meanwhile, the Fed's balance sheet swells into the trillions. It holds enormous quantities of U.S. debt, meaning the government owes interest to its own central bank. The interest payments loop back through accounting channels. On paper, it looks like cancellation. In reality, it doesn't erase the inflationary pressure already released into the system. Debt becomes less about repayment and more about perpetual rolling, issuing new bonds to replace old ones, forever pushing the horizon forward. This is how an empire finances itself without outward collapse. But the machine has a weakness. Confidence must never break. Because the moment investors believe the Fed will always be the buyer of last resort, the bond market changes character. It stops being a price discovery mechanism and becomes a policy tool. Yields are no longer signals. They become levers. And when yields are artificial, nothing else in finance is real anymore. The housing market stops reflecting income. Stock prices stop reflecting productivity. Savings stop protecting the future. Everything begins to orbit policy instead of value. The bond market, once the most conservative corner of global finance, becomes the engine of hidden risk. And every time inflation rises, the same nightmare appears. If the Federal Reserve raises interest rates to fight inflation, the cost of servicing the massive national debt explodes. Trillions more in interest, budget pressure, political tension, financial stress. If the Fed lowers rates to protect the debt market, inflation keeps burning through purchasing power. There is no painless exit. This is the quiet trap built into the bond trick. The government buys time by selling the future, and the public never voted on the terms. Behind the polished language of open market operations and quantitative easing, there is a simple truth most people are never taught. The United States no longer finances itself primarily through savings. It finances itself through monetary expansion disguised as debt issuance. A mirror economy. Debt sold to the world. Debt absorbed by the central bank. New money injected through the back door. Over and over again. And as long as confidence remains, the machine keeps humming. But history shows us something cold and unavoidable. Every financial system that relies on internal debt monetization eventually faces a moment where trust evaporates faster than policy can react. We've seen this movie before, just in different languages and currencies. And when that moment comes, it never announces itself with sirens. It arrives quietly, in small shifts in Treasury auctions, in weak demand, in failed bids masked by emergency interventions. The public only realizes something broke when prices move too fast to ignore. And right now, the scale of this bond machine is larger than anything ever attempted in human history. Trillions in circulation, trillions in promises, trillions in quiet self-financing. The greatest debtor in the world is also its own most powerful buyer, not because it is wealthy, but because it controls the printing press. And the question no one wants to ask out loud is simple. How long can a system borrow from itself before the illusion collapses into reality? The auction room itself looks calm on the surface. Rows of screens, quoted yields blinking in quiet rhythm, traders sipping coffee, no sirens, no shouting. But behind that calm, there's a tension that never fully leaves. Because everyone in that room understands one silent rule. If confidence breaks here, it breaks everywhere. The Treasury sells its debt into this room with the promise of safety, of yield, of stability. Pension funds buy it. Foreign governments buy it. Banks buy it. And on paper, it looks like a clean exchange. The world lends to America. America promises to pay it back later with interest. But the real machinery isn't finished when the auction closes. It's only just beginning. Because once the bonds are sold, the Federal Reserve steps back into the picture. not as a buyer in the open crowd, not loudly, not immediately, but through the side doors of the system, through primary dealers, through repurchase agreements, through balance sheet operations so technical they read like accounting footnotes. The bonds that were supposedly bought by the private market begin to drift, slowly, quietly, back toward the central bank itself. The government issues debt, the market absorbs it, and the Fed, in time, absorbs the market. It's the bond trick in its purest form, the state selling obligations outward, then reclaiming them inward with newly created money. To the public, it's described as liquidity management. To economists, it's called open market operations. To politicians, it's supporting the recovery. But to the system underneath, it is something much older and much simpler. Money being created to finance promises that can no longer be funded honestly through taxation alone. The Fed doesn't print paper bills for these purchases. It doesn't need to. It types numbers into existence. Digital reserves blink into life on bank balance sheets. And in exchange, the central bank takes custody of government debt, IOUs backed by nothing but future tax collection and collective belief. This is where the illusion becomes most powerful, because officially, the government is borrowing from the public. Unofficially, it is borrowing from its own monetary reflection. It is lending to itself through a maze of institutions that exist precisely to keep the public from seeing the mirror. The debt looks widely held. The yield curves still move. The auctions are still competitive, but the gravity of the entire market bends toward a single buyer of last resort, a buyer that never runs out of money because it creates the money it uses to buy. At first, this power was used cautiously, in crises, during panics, as a temporary backstop. The Federal Reserve was supposed to step in when markets seized up, then step back when normality returned. That was the original mythology, lender of last resort, emergency medicine. But over time, the dosage quietly changed. One program became two. Two became permanent facilities. Temporary measures stretched into years. Balance sheets that were once counted in billions ballooned into trillions. And before the public even noticed, the emergency door had become the main entrance. Every recession widened the doorway. Every market crash made the intervention less controversial. Every political fight made central bank financing feel more necessary. And the bond trick evolved with it. By the time the financial crisis of 2008 hit, the machinery was no longer experimental, it was essential. The government ran deficits so large they dwarfed previous generations. The Fed absorbed the shock by swallowing massive amounts of Treasury debt and mortgage securities, stabilizing markets with money that did not previously exist. The system survived, but it never went back to what it was before. Then came the pandemic, and the bond trick reached a scale that would have been unthinkable to earlier policymakers. Trillions in new debt were issued in months. Emergency relief, stimulus checks, unemployment expansions, corporate support, all financed by bonds. And almost as quickly as they were issued, vast portions of that debt flowed back onto the Federal Reserve's balance sheet. The government borrowed, the Fed created, the market intermediated, and the public saw only the final result. Money appearing in accounts, prices beginning to rise, assets soaring. This is where the feeling of unreality sets in. Because to ordinary people, it looks like the system is handing out money while simultaneously promising discipline. It looks like prosperity built on policy. It looks like the debt doesn't matter. But under the surface, every dollar created to buy government bonds dilutes the purchasing power of every dollar already in circulation. The tax is invisible. No bill arrives in the mail. No percentage is listed on a paycheck. It simply shows up as higher rents, higher groceries, higher insurance, higher tuition, higher asset prices that move out of reach for those who don't already own them. And the genius, the danger, of the bond trick is that responsibility becomes impossible to assign. Politicians blame inflation on supply chains. Central bankers blame it on fiscal spending. Markets blame voters. Voters blame corporations. Everyone points outward while the core mechanism quietly continues inside the system, untouched by outrage because it remains largely unseen. Foreign governments watch this process with a mixture of dependence and unease. They hold U.S. treasuries as reserves. They park their trade surpluses inside America's debt. And yet, they also know the truth. The dollar they hold is no longer anchored by scarcity. It is anchored by policy. It is anchored by the decision of a committee to keep the machinery running. When they buy treasuries, they are not just lending to the U.S. government. They are lending to the credibility of the Federal Reserve itself. China figured this out early. So did Japan. So did the oil-exporting states. They built massive treasury reserves not because the yield was attractive, but because the dollar was the only deep, liquid pool large enough to absorb global surplus. And yet, by doing so, they became participants in the very mechanism that eroded the value of what they held. Trapped in the bond trick, they could not exit without damaging themselves. For American households, the consequences felt slower, but no less real. First came the asset booms. Stocks climbed. Real estate surged. Those who owned financial assets saw their balance sheets inflate. Those who depended on wages fell behind. Then came the inflation that policymakers insisted was transitory, even as it spread from commodities into food, shelter, and services. The same policy tool that stabilized the bond market quietly destabilized everyday life. This is the paradox at the heart of the bond trick. It prevents sudden collapse by guaranteeing endless buying power, but it also guarantees slow erosion by ensuring that money is never fully restrained. The system avoids heart attacks by accepting chronic disease. And once a society normalizes that trade, reversing it becomes almost impossible. Because removing the central bank as the ultimate buyer of government debt would mean forcing the government to face its true cost of borrowing. And at current debt levels, that cost would be politically and economically unbearable. So the trick deepens. New tools are developed. Quantitative easing becomes quantitative tightening, then quietly becomes easing again under a new name. Repo facilities backstop bond dealers. Emergency lending programs widen. Balance sheets shrink just enough to suggest restraint, then expand again when markets tremble. The language changes. The reality does not. The bond market, once a place where price signaled risk, slowly becomes a place where price signals protection instead. Yields no longer reflect only inflation and default risk. They reflect how loudly the system believes the Fed will speak if trouble appears. They reflect how aggressively the central bank is expected to intervene when volatility rises. The invisible buyer reshapes the entire psychology of finance. Risk is not eliminated. It is transferred from private actors to the public balance sheet. And still, most people never see the transaction. They feel only its aftershocks. They feel it when savings accounts lag behind rising prices. They feel it when housing becomes a speculative instrument instead of shelter. They feel it when retirement depends more on the stock market than on stable income. They feel it when debt becomes the only way to bridge the gap between earnings and living costs. This is the quiet brilliance of the bond trick. It transforms public debt into private fragility. It turns national borrowing into household strain. It allows the state to finance itself without visible taxation, while redistributing purchasing power through inflation and asset revaluation. And because no single vote authorizes it, because it unfolds through technical operations most people never hear explained, it becomes the most powerful economic policy of modern times without ever becoming a democratic debate. And the deeper the system moves into this architecture, the narrower the exit becomes. Because now, the government is not just a debtor. It is a debtor whose largest buyer is its own monetary authority. To stop the trick would be to destabilize the very market that defines global safety itself. To continue it is to accept a world where money is permanently shaped by policy rather than production, by committee rather than constraint. The bond trick is no longer an emergency response. It is the operating system, and the system is running hotter every year. The trick only works as long as the crowd believes the magician still has real power. Bonds are sold because people believe in the future behind them. Dollars hold value because people believe someone, somewhere, will honor the promise. But history keeps whispering the same warning. When nations begin financing themselves by quietly buying their own debt, they aren't solving a problem, they're delaying an ending. What once required sacrifice now requires a button. What once demanded taxation now demands issuance. The debt grows, the buyers thin, the balance sheets swell, and the illusion stays alive just long enough for everyday people to keep trusting the numbers on their screens. The danger isn't sudden collapse. The danger is slow erosion, a currency that still exists, but buys less. A savings account that still shows a balance, but holds less life inside it. a system that still functions, but no longer serves. Every empire that learned this lesson learned it late. Rome diluted its coins. We dilute our obligations. Different tools, same direction. The bond market doesn't scream when instability arrives, it whispers. Yields inch higher. Demand grows cautious. Liquidity tightens quietly. And then, one day, trust costs more than money can afford. The United States has not escaped the laws of finance. It has only learned how to bend them longer than anyone before. But even the longest bend eventually reaches a breaking point. Not announced, not televised, not voted on, but felt in purchasing power, in wage stagnation, in the silent frustration of a population that senses the machine is feeding itself first. The bond trick is not theft by force. It's extraction by design. And once you see it, you can't unsee it. Subscribe if you want to understand the system before it understands you.